G'day guys, Nathan here from Hunter Galloway. Inflation has indeed softened slightly. Is it enough to change the Reserve Bank of Australia's course and plans for the interest rate environment? Despite the recent reduction in inflation this month, the cash rate currently sits at 4.1%. Are we going to see one more rate hike in the coming months, or are there more planned? This is an aspect that most prospective home buyers must take into consideration when making their plans, and it's exactly what we're going to cover today. We're also going to look at the growing speculation for a downturn in 2024, as AMP's head economist Shane Oliva presented some valid points, which we're going to explore later in this video. As rate hikes usually take time to trickle down to borrowers, the impact of such significant rate hikes could potentially lead to a reduction in spending and job cuts. We also need to bear in mind the resilience of the Australian property market. The recent immigration surge is likely to support the housing market in aggregate terms, along with the current supply and demand deficit, further fortifying the market. We've also seen a decrease in new listings, but at the same time, more buyer activity. On top of this, we see investors selling off, which could be influenced by a variety of factors, including high interest rates and capital growth. This opens up opportunities for prospective buyers, especially owner-occupier ones who might be open to purchasing a property that was previously owned by an investor. But prospective buyers should also be aware of the potential drawbacks, such as having long leases in place for existing investment properties or inadequate maintenance being upheld on the property. While there are indeed challenges ahead, the Australian property market remains robust and offers an opportunity for those ready to navigate its complexities. This is where you need to stay informed. Consider both the present market and future predictions, and seek advice from a professional like ourselves as a mortgage broker who can help ensure you're making the best decision possible. And while inflation is tempering, it might not be enough for the Reserve Bank of Australia to halt their plans. Inflation has softened and dropped to 5.6 annually in May, which propels the likelihood of the cash rate remaining unchanged in next week's meeting. The markets have reduced the chances of a rate rise happening in the July Reserve Bank meeting by 30%. However, there are a lot of the bank economists out there saying there is still the need for one more rate rise, which might come in the following months. The slowed inflation rate to 5.6% in May, down from April's 6.8%, was mainly driven by a fall in fuel prices, which were 8% lower over the year, and a drop in holiday, travel, and accommodation prices, falling 11% last month. Still, underlying inflation remains steady. Persistent price increases across varieties of sectors such as insurance, hairdressing, and dining out could heighten the Reserve Bank's concerns about managing inflation. The market based the likelihood of the Reserve Bank of Australia increasing the cash rate to 4.35% fell 30% after the release of the recent CPI figures. However, while the inflation figures might prove that the Reserve Bank has room to maintain the current cash rate at 4.1% in July's board meeting, it doesn't reduce the possibility of another one or two more rate increases in the future. Rent inflation driven by shortages of properties increased by 6.3% over the last 12 months, the fastest over the last decade. Likewise, energy prices have been a significant source of inflationary pressure, and this is partly due to the disruptions caused by Russia's conflict with Ukraine. Despite the gradual decline, high interest rates seem to be mitigating price pressures in some discretionary areas, like clothing and footwear, where prices fell by 0.4% over the last 12 months. AMP's head economist Shane Oliva speculates that the Australian economy is poised for a downturn in 2024, and this is due to the delay in effects of the Reserve Bank of Australia's aggressive interest rate hikes, which impact households' expenditure. And if you do find value in this video, please consider hitting that subscribe button, as it really helps out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content. We hope you enjoy. Shane Oliva emphasizes that there's generally a 12-month delay before the impact of rate hikes are fully felt. This delay occurs as the raised rates make their way to borrowers, leading to a reduction in spending and subsequently job losses by companies as a result. Furthermore, Shane Oliva highlights that this time the delay might be extended due to the abundant pandemic fiscal stimulus that had resulted in an unusually high savings amongst households during this time. The resurgence of pent-up demand due to reopening and a record 40% of borrowers opting in for historically low fixed rates as opposed to the typical 15%, and a fiercely competitive mortgage market have dampened the rate hikes and the impacts on the economy. Shane Oliva also warned that the Reserve Bank's monetary tightening policy has now started to severely impact households and the economy. He goes on to say that the security previously provided to households by fixing in their loans is evaporating as borrowers witness rates rising 2 or 3 times from their previous levels, and their savings buffers will eventually evaporate. Oliva pegs the probability of a technical recession later this year at 50%, and this is mainly due to the continued rate rises. The only factor preventing Australia sliding into a recession is the government's record immigration surge. This tactic has once more kept Australia's economy afloat in aggregate terms. The Australian property market's resilience is largely due to the supply and demand deficit. In May, new property listings were down 20% from the previous decade average. Consequently, the supply ratio indicating the time needed to exhaust the current stock on the market has decreased to 1.8 months. However, a notable contrast emerged when comparing the overall market trends with investor activity. Property listings that are investment owned due to rental histories were only 2.9% lower than decade averages in the month of May. In fact, in cities like Sydney, Melbourne, and Perth, investor listings surpassed the decade average. Inner city areas, popular among multiple property owners, saw a significant rise in investor listings. For instance, the city and inner south markets of Sydney, typically having 38% new investor listings, witnessed a surge of 57% in May. This highlights the ongoing investor selling activity amidst the declining owner-occupier sales. Though sales volumes are normalizing, a combination of a seasonal slowdown and increased interest rates could lead to a drop. Most buyers are typically owner-occupiers, and they might end up buying properties previously owned by investors due to an increase in investment listings and a lack of supply. However, factors like long leases or inadequate maintenance could deter owner-occupiers from purchasing these properties. And remember to like, share, and subscribe to stay informed with all things property and finance. The reason investors are selling their properties is currently unclear, and it might be due to high interest rate rises or the capital growth that they saw over the pandemic. For example, an increased mortgage costs on an average $500,000 loan by $860 per month to $3,200 as a monthly repayment might prompt an investor to sell. Similarly, in cities like Perth, which had increases in home values after a period of declines, saw a surge in investment activity and sales, suggesting investors are cashing in on their capital growth. While there are indeed challenges ahead, the Australian property market remains robust and does offer opportunities as long as you can navigate through the complexities. Stay informed and consider both the present market and future predictions, and seek advice from mortgage brokers like ourselves, where we can help you through the process. Here at Hunter Galloway, there's no cost for our service, and we work with home buyers right across Australia. You can reach out with us directly at huntergalloway.com.au or call us on 1300 088 065. Guys, thanks for watching today, and we'll see you next time.